The US jobs data came in mixed. Higher unemployment, but more jobs created than expected. But surprisingly, the US 10-year yield rose rather sharply, almost 10 basis points after what was seen as soft jobs data. In India, the August monsoon deficit and the rise in crude prices to almost $89 are keeping inflation fears higher for longer. Meanwhile, banks in India are already offering 7 to 8.5% for deposits, given the liquidity tightness. So to understand where the cost of money is headed in India, I have with me Robert Sockin, the global economist at Citi, and Neeraj Gambhir, the group executive and head of Treasury markets and wholesale banking at Axis Bank. Gentlemen, thank you very much for your time. Neeraj, with your permission, let me start with Robert. He's waiting. I think it's about 11 p.m. in the United States. So I'll, ask him about the U.S. scene. Robert, how would you interpret the jobs data that came on Friday?
I think if you were to write a script about what a soft landing type of data report would look like, I think it would look something very much like we saw in the latest jobs report. You saw job growth moderating below 200,000 to 186,000, and the pace and there would have been even a little bit higher if it weren't for a variety of strikes. Probably would have been about 50,000 higher on the month. But if you look at the pace over the last 3 months, that has moderated to about 150,000. So a solid pace of job growth still would put downward pressure over time on the unemployment rate, but not the kind of booming job growth that you saw last year. And then if you look elsewhere in the report, you saw that the unemployment rate moved up fairly significantly, but that was largely due, almost entirely due to an increase in labor force participation. In particular, we're finally seeing workers over 55 starting to come back to the labor market, which has been really the sticking point for labor supply in the U.S. Since the pandemic, you've seen almost no growth up until recently in that 55 plus measure, and you're finally starting to see that coming back. So I would describe that as kind of a good tick up in the unemployment rate. And then you also saw wage growth moderating as well. Still too high, of course, if you look at the trend for what the Fed is looking for. But, you're starting to see kind of some evidence of everything kind of moving in the Fed's direction with these data. Now, if you combine that also with the JOLTS data from earlier last week, where you saw the quits rate is now down to pre-COVID levels. So you're seeing a lot of evidence supporting that you're seeing this cooling but still solid labor market. And I think the Fed would be very happy with the data print.
So is the September rate hike off the table? And what about any more rate hikes? Are they also off the table?
On September, I feel very strongly that the Fed will pause. I think, as I said, the labor market data is moving in the right direction. Growth is still resilient, but inflation's moving in the right direction. So everything they're looking at, would lead them to think that they'd want to see more data, and there's no urgency to really hike at this point. In terms of beyond that, we've held on at Citi to one more hike. So we still think that they're going to hike in November because that upside risk from activity, we think, is going to put upside pressure on inflation. We think some of those inflation numbers are still going to stay too high through the end of the year for the Fed's comfort, which is going to lead to one more hike. But certainly the balance of risks are breaking in the other direction of that call. And as I said, September, I think there's almost no chance of a hike. And beyond that, I think, it's moving much more to a 50-50 type of call. Depends, of course, how the data evolve from here. But if the data keep looking like how they looked in this jobs report and the recent inflation prints in terms of the rate of improvement, then I think the Fed's likely on hold from here. Now, that being said, I think even if we're wrong and they don't hike anymore, I still think the bar for cuts is very high. So I wouldn't expect cuts anytime soon. The Fed's going to want to see the inflation decisively moving back to target. So I think cuts at any point this year, even if they're done hiking, is very, very unlikely. And I think even early next year is probably pretty unlikely. So we see them starting to cut in Q2 of next year. And given the amount of resilience we're seeing in activity, the balance of risks are maybe that those cuts get pushed out even further. So I still think it's hard to tell if they're done, but I think the odds of cuts anytime soon are pretty low.
Okay. Well, Neeraj, crave your indulgence for a minute more. I would like to let Robert go. Robert, just tell me, why are US yields high, especially the 10-year? It jumped back to 4.2%. Is this fiscal deficit fears?
Yeah, it's a great question. I think we've had a heated debate across analysts within Citi about really what's going on with the 10-year. I think the reason the 10-year has moved up, we've talked about this before. There's a variety of factors. Of course, first there's the supply issue with the government issuing large deficits. There's international monetary policy with what Japan has been doing, and that's moved some money away, likely from U.S. Treasuries into Japanese bonds. But first and foremost has been the resilience of activity and the look that likely maybe rates have to stay higher for longer, and that cuts are probably, if not going to come for a while, and if they come, are probably going to be relatively slow. I still think most likely the 10-year Treasury probably has to move down a bit from here. I'd be surprised if we could get much more upside. Maybe in the near term you could, but I think medium term, the 10-year Treasury likely moves down, because embedded in that 10-year Treasury, I think, is an expectation that the Fed is going to keep interest rates high for a long period of time and average a much higher policy rate than they did pre-COVID over the next decade. And I think that's hard to square, at least with where we think inflation is going to go, and that we think we'll be back to target by the end of next year. So I have a hard time seeing that the Fed is going to maintain a policy rate somewhere near 4%, which is what I think you would need to justify that type of 10-year pricing. So, we'll see what happens, but I think in the medium term, the path has to be down for the 10-year.
Okay, so thank you very much, Robert, for staying up for us. So you mean the yields could move lower probably next year or end of this year. Neeraj, now how does all this set up for India? First of all, thank you for your patience. We have our own problems. Vegetable inflation has become a broad cereals inflation because of the August rain deficit. So do you think we are in for some continued liquidity tightness because of inflation?
So clearly, I think the vegetable price-led spike in the inflation is something which is becoming a little bit more generalized, at least on the food side of the commodities. And therefore, I think the market, as well as, I guess, Reserve Bank will also be in the lookout to see as to how quickly it settles down. We know that the government has taken a number of initiatives. For example, the LPG price cut that the government has done is likely to have a meaningful impact on the headline inflation. Likewise, the rice and onion price, related interventions have all sort of tried to cool down that vegetable price-led inflation. But we are on the watch out, and we will probably see it for some more time before we can say that the worst is behind us. As long as we are in this phase where Reserve Bank is likely to continue to monitor the inflation outcomes, I think it's but natural to expect that the liquidity in the system will be more or less neutral and maybe a little bit of the tighter side. Liquidity is also getting impacted by the RBI's actions in the foreign exchange market. As we've seen pressure on the currency, we've seen some intervention by RBI to defend, and that has led to some liquidity tightness as well. So I think in balance, probably a bit neutral to tightish kind of liquidity situation in the system. Okay,
but Neeraj, crude prices are still have actually surged, inched up a bit to $89. It may become fiscally very difficult for the government to allow more cuts on, the excise and other fronts, because that will mean the oil marketing companies will have to take the hit, or the fisc will have to take the hit. So do you think from the Reserve Bank angle, it will be very difficult for them to change their liquidity stance? Their liquidity stance is pretty tight. Okay, do you think, therefore, they will continue in some form this incremental CRR or bring in some other liquidity tightness?
So we are just 4-5 days away from the incremental CRR decision, September 8th, when we were expecting, when a review is expected. I feel that incremental CRR will go away. That's my expectation. If there are more tools required to manage the liquidity, I think that's what will happen. Probably a more focus on VRRRs and some other tools if required. But I do feel that incremental CRR is probably not a very balanced impact on the banking system. But yes, expectation is that we will be in a neutralish to mildly tight liquidity zone. Unless and until there is a significant sort of inflows, which then Reserve Bank needs to intervene in the market to sort of, buy the dollars and hence release rupee liquidity in the system. Also, the government expenditure continues to be, moving the market quite a lot. We are seeing that now in the last 2-3 days, liquidity has come back into the system. The overnight rate has come back towards repo rate, but that's largely driven by the dynamics of government spending.
Yeah, but there will be, of course, advance tax payments on September 15 and then GST payments after that on 20th. So what is the expectation from the Reserve Bank and what is the impact on the banking system? We have advertisements running on CNBC TV 18, banks giving 7, 8, I think I even remember seeing 8.5% for some kind of term deposit. What's the impact on banks? Do you think this pressure to increase deposit cost is going to continue?
Well, we continue to see reasonably good growth on the credit side. And in terms of percentage growth, the deposit growth in the banking system is still lower than the credit growth side. So I think the banks, desire to continue to increase the deposit side of the equation will be there. I don't see that going away. And as long as the liquidity stays in neutral to sort of tightish mode, the banks will be continuing to sort of focus on, that side of the equation, continuing to see the growth in deposits. So the current pricing on the deposit side, I don't expect it to change materially. I think we will be here for some time, unless until the liquidity situation changes or the policy path changes, which again,
you don't
both
expect,
of these things are like, hey.
You don't expect further pressure on deposits? I mean, your best guess is that the Reserve Bank continues liquidity tightness in another way. They may remove the incremental CRR, but probably do, as you said, a VRRR or some FX swaps. So if they keep liquidity tight, you don't see deposits going up further?
I think the market is already priced in an overnight rate of about 6.5 to 675, right? That's kind of getting priced into the deposit market as well, particularly on the bulk deposit side and the CD side. So unless and until that equation changes, I think we are somewhere here. Things, it's also dependent upon an individual bank's balance sheet situation. So maybe they could face some issues here and there. But overall, I see from a macro perspective and from the banking system perspective, I think we're likely to stay here for some time. I don't expect a meaningful increase in the deposit rates from here onwards.
What about the 10-year yield or the longer tenor yields itself? The US 10-year is, in spite of whatever not so bad jobs data, is at 4.2, almost 4.18. So do the longer term tenors also keep rising in India or at least stay at current elevated levels?
US has a bit of an issue in terms of the fiscal deficit, the demand from foreign investors, and the fact that Fed is unwinding. There is QT going on. So all of these factors are combining to put some pressure on the US long bond yields. In India, I think the factors are pretty well known. There is reasonably heavy supply that the market has contended with in the first half. So as we roll over from September into second half, I think that supply comes off. So that's a bit of a bond supporting factor. But in balance, I expect the bond yields to hover around 720 to 725 level for some time, till such time there is a change in the path of liquidity or path of monetary policy.
Okay, but would you say, therefore, the second quarter is likely to be a little tough on bank balance sheets, both in terms of NIMs and in terms of possible mark-to-market gains not being there?
Yeah, we are kind of flattish in terms of bond yields in this quarter so far, right? So that should give you some idea of what's going to happen on that side. The second aspect of NIMs is that the deposit repricing is still continuing in the system. So that is also likely will be getting reflected overall in the banking system's cost of funds. So yes, I think on both of these sides, these are very expected sort of phenomena that is likely to play out.
Okay. Well, actually, on June 30th, the yields were lower than 7.1, and now they are, as you say, closer to 7.25. And September is a tight month in terms of liquidity outflows. So maybe there is a little bit of pressure on bank treasuries as well. Tough job for you to handle. Thank you very much, Neeraj Gambhir, for joining us with your take on how you see Indian yields and, more importantly, the cost of money because liquidity is likely to be kept tight by the Reserve Bank. We have to wrap up on Bazaar. On that note, of course, equity markets are in a fine spot. Chartbusters will take the action forward.